Hi everyone, I'm HT and I'm a data scientist at Gauntlet. Today I want to talk about an analysis of the market's risk to participants in the Compound protocol. Compound protocol facilitates participants to trustlessly supply and borrow Ethereum assets. An Ethereum asset holder can supply assets to Compound and earn interest, whereas an asset borrower supplies assets as collateral and borrow assets from Compound, which is effectively opening a leverage position. However, risk assessment is difficult for the participants because of the multitude of participants' behavior, protocol's endogenous variables, and exogenous market variables. We constructed an agent-based simulation model to perform stress tests and evaluate the economic security of the protocol. In the Compound protocol, the main assets are the collateral tokens that suppliers have committed to liquidity pools. And the main liabilities are the outstanding borrowed assets. Here's a screenshot of the Compound Markets Overview dashboard. If we look at the data, we find that the predominant use case in Compound is that users supplies Ether as collateral and borrow the stablecoin DAI from Compound. Since the protocol forces borrowers to over-collateralize their borrowed assets, the total value of the supply assets must be greater than the total value of the borrowed assets. There's a nuance on how assets are treated in Compound. Technically, after the supplier supply the native assets, they will get C tokens in return. C tokens serve as contingent claims on assets and earn interest. The borrower also must hold C tokens as collateral and borrow from the protocol. Unlike the traditional saving account, the interests are being paid every month or every couple of months. What C token enables is that the interests are paid pro rata on every block update, as long as you hold the token. From the Compound user's perspective, here are the risks he should be aware of. The first risk is the smart contract security risk. One example of this risk is bugs in the smart contract. The risk can be mitigated by security audits or formal verification. Compound has worked with multiple third-party auditors, including OpenZeppelin, to mitigate the risk. The second risk is the governance risk. This includes the admin's private key gets compromised. The third risk is the market risk. The primary source of the market risk comes from the three components. Shocks to market prices of collateral that causes the contract to become insolvent due to under-collateralization. Loss of liquidity in an external marketplace, leading to a liquidator being disincentivized to liquidate defaulted collateral. Cascades of liquidations impacting external market prices, which in turn lead to further liquidations. We also call this a deflationary spiral. For an open permissionless protocol like Compound, no single third party is in control of the asset supply and demand. So how does Compound ensure that the net liabilities are always positive and users will never lose their fund? Liquidation mechanisms or liquidators are the key to prevent the system from default. Compound utilizes a series of incentives to ensure that the net liabilities are always positive. The collateral factor defines a maximum borrowing capacity for each asset enabled within the protocol. Assume the collateral factor is 0.75, and the price of 1 Ether is $100. In this case, a user can borrow up to $75 worth of DAI. When the market value of the collateral asset Ether drops from $100 to $66, The borrowing capacity will also drop to $49.5, which is below the value of the borrowed assets. When this happens, the collateral position becomes liquidatable. A liquidator can repay up to a half of the borrowed position, and the collateral value received is equal to 105% of the repaid value. The protocol effectively sells the collateral at a discount, termed the liquidation incentive, to a liquidator to prevent the collateral being under-collateralized. If no liquidator is willing to step in to liquidate the position, and the price of Ether drops further to $49, a borrower will walk away with his borrowed position, since his borrowed position worth more than the collateral. In this case, the position is under-collateralized. The asset supplier's fund is at risk if the liquidity pool is under-collateralized. In this analysis, we try to answer the following question. Is the protocol able to grow safely under the volatile market condition? We study the relationship between the liquidations and the market's variables, especially the volatility and the size of the debt, and answer the question through agent-based simulation. Liquidation incentive and collateral factor are two of the most important protocol parameters. Liquidation incentive creates an arbitrage opportunity, or a price discount for the liquidator in exchange for the reduction of compound's risk exposure. The higher the liquidation incentive is, the more liquidators will participate in the liquidation process as they get steeper discounts relative to market prices. The collateral factor defines a minimum collateral requirement for each asset. Borrower must manage their own position and keep it over-collateralized to ensure a certain margin of safety with respect to the maximum borrowing capacity. Risk-averse borrowers maintain a high margin of safety to avoid their collateral being liquidated. In contrast, risk-seeking borrowers maintain a low margin of safety and actively refinance their debt to optimize their usage of borrowed capital. Liquidation incentive is the main economic incentive to liquidator. So what makes liquidators unwilling to liquidate a position? The answer is price slippage. Slippage is the difference between the market's minimum price and the actual average execution price when the market's participants execute a trade. To simulate the worst-case scenario for compound, we assume that all liquidators are greedy and sell the received collateral immediately to a centralized exchange. The reason for selling the collateral to a centralized exchange is twofold. Order book debt on centralized exchange is order of magnitudes greater than that of decentralized exchange for most assets. Slippage in automated market maker, like Uniswap, has a linear relationship with trade size, so it is usually designed to be expensive for large quantities. Greedy liquidators will likely end up going to a centralized exchange during the most volatile time to stay profitable. So slippage is one of the major factors that influence a liquidator's decision. When the slippage exceeds the liquidation incentive, a liquidator has no incentive to arbitrage. The trade size and asset volatility are two main factors that affect the price slippage. We define the outstanding debt as the sum of all the borrower's total outstanding debt values, normalized by the average daily trading volume of the underlying collateral. The metric captures the size of the debt relative to the underlying liquidity. It also enables us to easily apply the same model to evaluate and compare different pairs of collateral and borrowing assets. The simulation assumes that the borrower's borrowed DAI backed by Ether. As an example, suppose that the Ether daily trading volume is 100 million USD. 0.5 outstanding debt is equivalent to 50 million USD of total outstanding debt value. Asset volatility is the standard deviation of logarithmic returns. It measures the degree of variation of asset price change over a given time interval. Studies show that the volatility is typically a linear coefficient in a slippage model. We use agent-based simulation model to perform stress tests on compounds Ethereum smart contracts. This ensures that the simulation environment replicates the live environment as closely as possible. Simulation-based stress test has been used for estimating censorship in cryptocurrency protocols, detecting fraudulent trading activity in CFTC exchanges, and Federal Reserve and the European Central Bank. It's also being widely used in industries like algorithmic trading and marketplace simulations for self-driving vehicles. Here's an overview of the compound simulation model. We use compound smart contract to simulate the protocol mechanisms. We use geometric Brownian motion to generate synthetic Ether price trajectories. The slippage model is trained by Coinbase Pro order book data. We use compound on-chain data and kernel density estimation to sample the borrower collateral value and collateralization ratio from the distribution. In terms of agents model, we have three different types of agents. Suppliers supply DAI to the protocol, and borrowers supply Ether as collateral and borrow DAI from the protocol. Liquidator liquidates borrower's position if there's an arbitrage opportunity. Once the liquidator receives the collateral, he will immediately sell the received collateral on a centralized exchange to arbitrage. The key metric to measure the safety of the system is the under-collateralized run percentage. An under-collateralized run is a simulation run that ends with greater than 1% of the value of the total outstanding debt that is under-collateralized. Under the same market parameters, we generate multiple random price paths, run the simulation, and calculate the percentage of the runs that are under-collateralized run. Here are the simulation results. We show the mean cumulative liquidator profits and costs over 24 hours. We simulate Ether price trajectory with both 3% and 50% daily volatility. The y-axis is linear scale on the left and log scale on the right. We find that the price slippage is the major cause of arbitrage. In the high volatility scenario, the slippage cost is around 30% of the liquidator's revenue. Trading fees in both cases are roughly the same percentage of the revenue. An on-chain transaction fee is insignificant under the current constant gas price assumption. Here we show the total liquidated debt amounts over a 24-hour period. The results match our intuition. The total liquidated debt amount is proportional to both total outstanding debt and volatility. In the high volatility scenario, a borrower's collateral value has a higher chance to fall below the collateral requirements and hence get liquidated. We also find that liquidations can serve as a leading indicator of under-collateralization. Finally, we want to understand under different volatility and total outstanding debt assumptions, how many percentage of the simulation runs that will end with greater than 1% of the liquidatable debt, as shown in the top figure, and under-collateral debts, which is on the bottom. We found that when the daily volatility is 20% and the total outstanding debt is greater than 100 million USD, A few risky borrowing positions will not be fully liquidated at the end of the simulation runs. However, none of the borrowers are under-collateralized. The protocol is safe when the volatility is below 35%, and the liquidity pool's total outstanding debt value is below Ether's daily trading volume. As the volatility reaches 45%, some suppliers may be unable to withdraw their supplied assets. The protocol should be robust enough to scale to at least 10x the current borrow size, as long as Ether price volatility does not exceed historical highs. In the future, we'd like to create a better model for on-chain transaction fees, as opposed to using constant gas fee for simulations. We'd also like to use the Black Thursday and other flash crash data to better simulate the long-tail events. Our methodology can also be applied to other collateral types on Compound with significantly different liquidity profiles, such as REP. This work also informs the Compound community on how to evaluate market risk for new assets as they are added to the protocol. Thanks for listening.